I think that'd be hilarious.
What do you think?
How's it going, everyone? How are you?
Call it spade a spade, right?
I mean, come on.
The best thing that can happen to you.
How much money did you guys take out up front?
On that side.
Heard all this stuff?
Thank you.
Oh, thank you.
I missed you here.
There you go.
Thank you.
Great.
Like the folder, guys.
Thank you.
You have children?
She doesn't want the folder.
Good for you.
Oh, gotcha. Thank
For my
you.
children? Okay. For your child.
Okay.
All right.
Thank you for coming.
Hello, everyone. It was very nice to see you at the Chicago Air Transportation Conference last quarter. It is very nice to see you again here today, and we hope to bring some clarity to what is somewhat a uncertain situation here. And before we really get into the nitty-gritty analysis and recommendation, we wanted to give you transparency with the direction of this presentation. So first, we're going to start off with our background, give you a little bit about our experience, and try to help you feel more confident partnering with us, with our experience. And then we're going to move into industry outlook, expanding upon the industry information that was generously given to us through management. Then we're going to dive into situation analysis, highlighting key points that we see. Then we're going to dive into valuation, taking a 10,000 feet view of Great Lakes valuation as a whole. And then we're going to reveal our recommendation and then walk into next steps, how we're going to walk it through a potential transition. And then we'd like to open up the floor for questions. And if you have any questions throughout, please don't hesitate to ask. So here at Altitude Advisory Group, we aim to exceed client expectations every chance we get, based on our core values of integrity, discipline, excellence, and innovation. I'm Curtis Greenwood, and I'm a managing director. I have 21 years of investment banking experience, but I've been here at Altitude for 10 years now.
My name is Dylan Halter. I have 17 years of banking experience, 10 of which at Altitude.
My name is Jackson Van Warmer. I'm a vice president. I have 12 years of investment banking experience, 2 of which are at Altitude.
My name is Grant Dreer. I'm a managing director here at Altitude Advisory Group, and I've been here for 6 years with 14 years in total of investment banking experience.
My name is Sheila Iyer. I'm a managing director here at Altitude as well. I have had experience for 14 years working at Altitude for 7 years. And so I'll bring us to, why choose Altitude Advisory? So some of the main factors, the main thing is we're local and we understand this industry very well. There are several other M&A firms who can take you through the process, but not other firms who can take you through the process, stay with you during the process, and make sure that the transaction is completed successfully. We have several awards detailing our M&A experience, but our biggest differentiator truly is our sector experience. We were voted the best airline and travel M&A firm by Wall Street Journal, and we feel very strongly about our success and encourage you to choose us for our experience in the airline sector. So move through some recent transactions to kind of show some of this experience. So you can see some of our recent transactions are between the range of $430 million and $1.2 billion. And so the Great Lakes Regional Airways deal being around $1.1 billion fits right within our sweet spot. And we feel that looking at Zenith Air or Airwings deals, they had very similar dynamics as to this Great Lakes Regional Airways. So we feel that combining those with, and those had even higher regulatory complexities, we feel that we're set up very well to have a lot of success with this deal.
I wanted to start off our analysis by giving a bit of a look at the industry and what's been happening over the last couple of years. A key factor that we've seen has been margin compression, and this is mainly because pilot composition is up. We're seeing state legislation, which has increased labor, as well as safety regulations, and we're also seeing enhanced maintenance expenses. And with that being the case, we are seeing a wave of consolidation where scale and capital are becoming key. And if I can direct you to the bottom right corner of that slide, you can see that Delta Airlines and United Airlines both have the largest scale, and in that they also have the highest EBITDA margin, both showing that. And that's mostly just because of higher purchasing power with the higher scale.
And then I'll dive a little bit into what's happening within Great Lakes in comparison to the industry. As you can see, the margin compression hasn't been as severe for Great Lakes, but still below that peak that we saw in 2023. And this isn't looking to get any better over the coming years, as newly enacted legislation is going to increase payroll costs by 26% by 2030. And at the same time, we're dealing with an activist investor coalition, which makes up 9.6% of outstanding shares. And they want to see management cut costs as well as enhance scale. If these needs aren't met, we could see a large share sell-off or possibly even an attempt at a hostile takeover of the board seat. With that in mind, I'm going to pass on to Curtis for evaluation.
Thanks so much, Jackson. And as I mentioned earlier, the goal of this is to take a step back and look at Great Lakes valuation from a holistic perspective. And as you can see, our fair value that we derived, on the high end, we have $160 per share, and on the lower end, we have $84 per share. And we've derived this through various valuation techniques, one of which being the discounted cash flow model, which we were able to put together through the financials that were generously given to us by management. We derived both sensitivity analysis and scenario analysis, which was how we generated this range. We took a base case, which was management, and we created a best case and weak case scenario. And to move on to our other methods, comparable companies analysis, really to compare apples to apples. We chose comparable public companies based on size, geographic location, operations that were similar to Great Lakes. We used EV to EBITDA and EV to EBIT multiples when doing this. We also used precedent transactions, which is very similar to the methodology of comparable companies analysis. However, instead of using public companies, we're utilizing recent transactions. And we really honed in on the relevancy of these recent transactions, as well as some of the factors I mentioned previously with the comparable companies analysis. And as you can see, Midwest Connect's offer of $140 per share is right on the upper quartile of our fair value. And that leads me right into...
How do you explain the massive differential between the public comparables and EBITDA and EBIT?
Yeah, so that's a good question.
What's more important, do you think, the EBITDA or the EBIT in terms of what we should think about our value?
Well, let me take it from this perspective. So we included both because airlines are a very debt-heavy industry. Capital structures can vary. So EBIT and EBITDA both take debt capital structure out of this consideration and give more of that apples-to-apples comparison. And we use both EBITDA. It's different accounting treatments. So again, airlines, very asset-heavy industry, so therefore depreciation is most likely going to be very heavy. So it gives us two different perspectives. And I would assume this is the EBIT multiple would be because that depreciation is taken out of that account. Thank you for the question. So that $140 per share based on our fair valuation on the upper quartile, and that does lead us right into our recommendation. So our recommendation would be to accept the merger offer. And the first reason would be what I just alluded to on the previous slide here would be that it's a very fair value from Midwest Connect. Another reason would be through merger model analysis, we identified that this deal would be extremely accretive, and that's done through both cost and revenue synergies. Midwest Connect's board predicted that on a low end, we would get $85 million in projected cost synergies, and on the high end, $95 million in cost synergies. And we assumed we'd also receive a lot of revenue synergies from customer diversification. As you know, Great Lakes caters more towards business travelers, while Midwest Connect caters more towards family. This customer diversification wouldn't only de-risk Great Lakes, but it would also provide more revenue streams. And finally, our last point that Jackson alluded to earlier is satisfying the needs of activist investors. This merger would account for both cost cutting and scale.
How do you,
Sorry, go ahead.
yeah, how do you guys think about us losing control in an optic sense with Midwest CEO taking the helm versus our CEO taking the helm? How do you think about that in terms of this offer?
That's a good question. We don't see.
Do you think there's risk there for us, I guess is what I'm asking.
I can kind of touch on that a little bit. So with Midwest CEO coming in, that's a valid point, but we're retaining the CFO, so we'll keep a level of institutional knowledge while also bringing in expertise from another company during the merger. So we'll get kind of a combination of both that we feel will help make this a successful merger.
Okay, thank you.
So I'm going to pass it off to Grant to go over different options and the rationale behind this.
Thank you, Curtis. Yeah, so now that we have a better understanding, or we've conveyed to you our understanding of the benefits that the merger would provide, I wanted to take a look and really explain by comparing and contrasting the different options that could potentially be on the table, exactly why we believe accepting the merger is the best decision. So if we just, for a moment, considered maintaining the status quo, one of the things that would do, obviously, you would get to maintain control of the Great Lakes name, and you would avoid any delays associated with the merger process. With that, though, maintaining the status quo, you're not going to gain access to those synergies we talked about, both the cost and revenue synergies, as well as the co-marketing partnerships that Midwest Connect has already obtained with hotels and rental car companies. And on top of that, you do run the risk of pretty severely upsetting the activist shareholders who are pushing for scale enhancement and cost reductions, which we see the merger offering both. And so as we see it, maintaining the status quo not only lowers the opportunity for growth, it actually jeopardizes stability as well, given that the activist shareholders could push for maybe a board seat or even some sort of mass sell-off of shares, which of course, would be very harmful to the company. With that, another option that could potentially be on the table would be a private equity buyout. But again, we don't feel that this is the most viable option. And the reason for that is you would get to, again, retain the GLRA brand. But the downside here is there's less opportunity for synergies as you're not being directly presented them in any type of private equity deal. It doesn't directly address the demands of the activist shareholders. On top of that as well, we've also seen some liquidity problems, as well as high interest rates, which are pushing people away from private equity deals in the current market conditions. And so with that, we don't believe that a private equity buyout nor maintaining the status quo would be the most viable options for the company. Other than just directly accepting the merger offer, there is the option of renegotiation. However, we do not believe this is viable. And the main reason for that is accepting the offer now provides certainty and stability. Renegotiating introduces the risk of the deal falling through, and it also introduces the risk of the activist investors becoming increasingly upset with the decision if the deal ends up not going through. So that first risk there on this slide here is the deal collapsing. So as I said, if the deal collapses, according to prior market checks, there's no indication that there's any other buyers currently willing to acquire or merge with Great Lakes Regional Airways. And so really, if the deal collapses, there's no other option that is as convenient as this deal and as beneficial as this deal to the company. On top of that, the offer is already at a premium valuation. When we look at the valuation of the company, the current PE and EV/EBITDA are above industry averages, indicating that there's already some amount of premium built into the valuation of the company. On top of that, with the control premium that you'd be receiving from the merger, we see that as not just fair, but actually a premium valuation for you guys with the merger offer. And on top of that, like I said before, if the deal were to fall through, these activist investors are a major risk to the company, as they could grow increasingly large in proportion of shares, and also grow increasingly frustrated by the lack of scale enhancement and cost reductions, which again, the merger would offer both of those. And just taking a look at the potential downside versus upside of the deal. So if we were to renegotiate the deal, we see the potential downside of the deal if it falls through being -12 to minus $25 per share. And this is just assuming that the control premium that you're getting offered in the merger, is not built in that would just be the standalone value of the share price. So with that, we see much more downside than potential upside, considering we're already kind of near the top of that valuation range that we derived. We see about plus $5 to $10 per share, even in realistic negotiations. So with that, we do not recommend renegotiating. We recommend that you take the stable and certain choice of taking it down.
That's a question. Do you feel like if we just take the offer on the table, we're signaling weakness and just inviting a renegotiation later if they know about the activist shareholders?
That's a good question, and I think it's a good perspective. From the way we see it, the risk of the deal falling through, from our perspective, is much higher actually than really. Renegotiating is not justified because of the amount of risk with the deal falling through, and considering it's already at a premium valuation, we think it is just a smart decision now to accept it, take that certainty, take that stability, and then you don't have to worry about those activist investors anymore.
And if I could add on to that as well, I think a big point here is with the market check, there was no material bids that happened. So if this deal were to fall through the renegotiation process, there's no solid chance that we can find another deal because we already tried to prove that in the market.
That was a couple of years ago, right?
That was a couple of years ago?
The market check, so.
Yeah.
Do you guys have relationships with some other potential buyers to be done some of that check and help lead you to your more updated view that it's not worth the formal process?
We have, but I think the current market valuation is a big, not necessarily a red flag, but a key point that they want to point out because a lot of that premium is already built in. And I think that's what they really want to avoid having to add any more on top of that.
I don't understand your control premium argument. Median is 30%, only getting 9%. It's not a merger of equals, right? Their guy's going to be the CEO, and I'm not. I'm just saying I'm CEO. So we need more money. Help me understand your rationale there.
Yeah, definitely. So one thing I will say is if you take a look at the current PE of the company and the EV/EBITDA, it's already significantly above the industry averages. So in our perspective, that premium is already somewhat built in to the price of the company. And so while yes, you are potentially seeing a lower control premium than the average, you have to understand, I think, that you already have some of that premium built into the valuation of the company. And so with that, not accepting the merger provides more risk than there is potential upside in renegotiation.
So what options do they have? They need our fleet. They need these planes. They're not going to spend billions of dollars buying 100 planes.
Right.
We're the best option. So why not go back to them and ask for more?
I think from our perspective, both companies need each other, and that's because the synergies that would be introduced through the deal, as well as the accretion that would be provided by the deal, is very massive. So, there's really side of the benefits, which we have talked about, which we feel are very significant. And on top of that, there's also the risk of the deal falling through. The activist shareholders being involved really is a two-sided issue, but the benefits alone are, they make the deal fairly justified. And when you consider the risks of not accepting the deal or renegotiating and the deal falling through, we believe together really justifies accepting the offer now.
We can't just take their offer, guys, right? I mean, we got to find something to justify your fee and our fee. What's the one thing you'd go after to make it feel better that we're just kind of rolling over and taking their offer? What's the one thing you'd want to see them enhance?
That's a good question. From my perspective, at least my understanding on the situation, the accretion and synergies of the deal, you're all shareholders. I mean, that amount of accretion is valuable for the next couple of years, right? So I don't think the focus should be, based on our analysis, it's a fair valuation right now, but if we're looking forward into the future, that accretion that we get by the combination of forces is much greater than that initial deal.
Maybe to keep your job.
How
I know, right?
How does our leverage factor into your reputation, current leverage level of our company?
Yeah, so it definitely impacted elements of our valuation. For example, we tried to find comparable companies with similar leverage profiles. That's also built into the weighted average cost of capital for the discounted cash flow. So it's built into the valuation. Did I answer your question effectively?
No.
Okay.
So do you think we have high leverage or
Yeah.
low leverage relative to other people? And what is that, how does that impact what we should do in regards to the Midwest?
Yeah, so we typically have higher leverage at 10.5x debt to EBITDA. So
That gives us less options to go forward, or your analysis, it would seem to be that we should take the deal because we have less options given the higher leverage.
yeah, so I'm not sure I quite understand your question. Sorry, could you
If we have a high amount of leverage
Yeah.
as a company, it would lead me to believe part of your recommendation to take this deal because there's such high amount of leverage, we don't have a lot of other options. It's status quo or finding other potential buyers.
Mm-hmm.
But you didn't factor in that part of our situational analysis into those two recommendations, which maybe needs to be part of that.
That's a good point. That's a good point.
Questions from the board? No?
Thank you for your time.
Yeah.
Thank you so much.
Thanks so much. Appreciate it.